In this part of the program today, we're going to be talking about gold confiscation. We're going to talk to people that are actually in the business, get their perspective. And our first guest is Nick Barashef. He's CEO of BMG Bullion Funds. And Nick, there was a paper that was featured on a website. It was called Gold Confiscation, How Likely Is It? What You Can Do About It? And it listed all these provisions from President Nixon closing the gold window to presidential directives to actions by Congress, all these kind of things. So let's begin our discussion. Is it likely, or is it a possibility, or is it eventually going to happen? You get all kinds of people that are in your space dealing with bullion saying, no, you got to be in numismatic coins because they're the only safe thing that can protect you. Or there are other people who say, no, your job when governments are basically printing money is to own as many ounces as you can, and the more ounces you can own at close to the spot price, the better off you're going to be. So what's your take on this?
Well, I guess the first thing that I need somewhat clarification is, in my view, it wasn't a confiscation, it was an expropriation, because they did current market value for your gold. So they just didn't take it from you. And I don't know that they would have the right now or then to do that. So that's the first part that I think is critical to understand. The second part is that we have to remember that the U.S. was on the gold standard at the time. And when you look at statistics, there was roughly $9 trillion of currency and money. And at the time, there was about, out of the $9 trillion in total, there was about $4.2 trillion of gold and just under $1 trillion of silver. So the gold already represented about 50% of the total currency and money in circulation. So today, though, in contrast, we have $1.8 trillion in terms of M1 and $14 trillion in terms of M3. And the amount of gold at 8,000 tons is worth just about $330 billion. And if we assume on a high point that the American citizens have as much gold as the government has, 8,000 tons, which I highly doubt, because most investors and people have no gold in their portfolios, and the institutions don't have any gold. So when you look at those numbers, it would serve no purpose to try and confiscate something like $300 billion in gold against the current money supply. What is it going to do for you? The other issue is that they've, unlike 1933 when they were on a gold standard, they've spent the last 80 years denigrating gold, that it's an archaic relic, it's, not money and it's worthless and so on and so forth. So what point is it to then reverse that and say, oh, we were wrong, so now we need the gold, So I think those contrasts make it unlikely that there would be a confiscation until and unless the economic conditions and financial systems got that bad where gold was north of $5,000 an ounce. Because that's the amount you get if you just try and cover M1.
And if they were to do that, Nick, you've seen some of the pictures of 1933, people lined up holding their sacks of gold outside a bank, and as you point out, it wasn't confiscation. They actually, at the time, the going rate for gold was $20 before Roosevelt devalued it. So gold was going for $20, and they paid you $20.
That's right.
So would people today be as compliant? In other words, if gold got up to 5,000, it would indicate that we had higher rates of inflation, the paper money was debasing, people were seeing it in terms of, the cost of food, energy, the stuff that we saw in the 70s. I just don't see a compliant population in the same way that, let's say, with the Internet today that we saw in the 30s.
Well, I agree. I think, between that and the fact that there's probably, thousands of times more lawyers to take these issues to court. But apparently, from what I've read, also in 1933, there was only something like 20% compliance. Like a lot of Americans put their gold in the hiding. A great deal of them moved or bought gold in Canada. I know several Canadian dealers that were that said that that's what happened in the case, and even between 1971 and 74, there was a lot of Americans buying and storing their gold in Canada. And Canada never had this kind of expropriation or anything like that, so we don't have that kind of a precedent. But like I say, to me, the only time that would be worthwhile is north of $5,000, in which case we've got major crisis, and if that did happen, then, and you had gold, you're better off getting $5,000 an ounce than not having gold. And to me, holding numismatic coins in the 1933, and before gold eagles, there's just not enough of them to make any difference to anybody with any kind of wealth. And the premiums are, in some cases, I've seen premiums of like double the gold price.
And it would seem to me, and I have always held up, Nick, to what I call the Willie Sutton theory of gold confiscation or gold expropriation. And that would be, if the government was really after gold, why go to Larry Lawnmower's house for his few gold eagles that he may have when you have the gold ETF GLD, which most people use as a trading vehicle for convenience. So let's say that the gold ETF is trading at $5,000 an ounce. If you're a gold trader, you own the gold ETF, gold's at $5,000 and the government offers you $5,000, what do you care?
Well, that's exactly the point. And the thing is that for the government to need the gold, there'd have to be a complete breakdown and loss of confidence in the U.S. currency.
And if that's the case, is it really going to be in the government's best interest to try to knock on every single door in the country to get some guy that may own one or two gold coins?
They didn't do that in 1933. They didn't really go door to door. They put in the regulations, put in punitive measures, and those people that turned in their gold, that was that. The only other thing was the safety deposit boxes, which they didn't allow you to open your safety deposit box without an IRS inspector looking over your shoulders. And in many cases, those safety deposit boxes were never opened because they had other things in there that people didn't want to reveal, not just the gold, so they were never opened.
And I would just think, once again, if you want to talk about best return on your efforts, why not go where the largest storage of gold is? I mean, it would make more sense to go after an ETF than send agents to scramble and maybe, you hit 5 city blocks and you come up with 1 or 2 eagles.
I think like the confiscation of gold, in terms of the views of Americans would be similar to trying to confiscate the guns, Good luck on either count.
Yeah, and not only that, with some of the gold bug, you'd be putting your life at risk if you tried to do that. That's interesting because my own state of California passed a law that was just overturned by the courts, and they were going to stop people from buying ammunition outside the state over the internet. And all of a sudden, every lawyer in the state showed up, and the courts turned it down. So, if the government passed some kind of decree because of who knows, some administration decides that they get a whiff, hey, we're going to do this. I've seen some crazy things in my own state of California here, so maybe we ought to exclude California because we're kind of full of nuts and granola here. But we've done some goofy things, but I just don't see that paying off.
Well, I think, too, there'd be bigger challenges today, like I said, because of the increase in the lawyer population and so on, because it seems illogical how you would have the right to confiscate constitutionally lawful money from the citizens.
Yeah, it just seems there's too many constitutional issues, and once again, we're no longer on a gold standard as we were in 1933. But, let me bring up some other things. There's a lot of conspiracy buffs out there, and, we've addressed this before on the program. There's a couple big bullion banks that are dominating this. We've got the healthcare law where we're going to have to pass, unless they repeal it, you're going to have to report $600 of bullion sales or purchases. So a lot of conspiracy people have pointed out that this is the prelude to, let's say, expropriation. Mm-hmm. How would you handle that? What would be your response?
Well, hopefully with this new kind of Republican majority, some of that eases off because a lot of these regulatory reforms are just not good for business and not good for employment. So to me, it seems you need to back off a lot of these issues. And there's a lot of resistance to it, and primarily the negative impacts it would have on businesses.
Yeah, I mean, if that was to go into effect, I mean, I buy office supplies, so I'm going to have to issue a 1099 to...
Yeah, it's just like a ridiculous amount of added bureaucracy. It's not just for gold, but it's across the board. So I would hope that with the new majority then and the strength of the Tea Party that be repealed and so on.
Well, they're already talking about repealing. If they don't repeal the whole bill, even the Democrats have offered to work with Republicans on repealing some of the onerous things. And I can't help but think, and even the president wrote an op-ed piece this week in the Wall Street Journal where by executive order, he's repealing some of these bureaucratic log jams that are really harming business. And I can't help but think this $600 1099 thing that they want to put into effect in 2013 or 2014 would certainly be at the top of the list. I mean, I don't want to give the guy that comes out and repairs my Xerox machine a 1099 or anybody that does anything. How about the janitor that cleans the office? I'm going to give him a 1099?
They slipped all that in the 3,000 pages of the health care bill, which has nothing to do with the health care bill.
So as you look at this and you look at confiscation, and as you pointed out, it's really sort of expropriation because it wasn't like the government took people's gold. The going price of gold at that time on a gold standard was $20 an ounce. And if you had one gold coin, that's what the government gave you. They gave you $20.
Exactly. Well, and like I say, to me, this couldn't occur unless the financial conditions were so bad and the loss of faith in the paper currency was so high that you'd be, well north of $5,000 an ounce in gold before that would even be a remote consideration. Until you get to there, why do it at all after you've spent 80 years trying to get everybody to believe that gold is an archaic relic? So why do you need to confiscate it or expropriate it?
Now, one thing that we've also seen we've seen countries like China. Actually, China, if you look at the way they're going, are becoming more capitalistic than the American capitalist. And they're accumulating this stuff. I can't help but believe we're going to see a world where maybe what we end up doing is having large currency blocks. There's a yuan currency block. There's the Amigo, whatever they're going to call it here in North America. You already have the Euro. Maybe you get the Globo. I don't know what they're going to call it, but
that's clearly the long-term agenda. But we can see how well that's working in the Euro so far. I don't think you can have currency blocks without a political union. And, it remains to be seen whether the Euro will even work. But it is, when you talk about China, it would also be hard to conceive that the U.S. would bring in these prohibitionary practices as the leader of the capitalist, democratic, free world when the Chinese are liberalizing the ownership of gold and, in fact, encouraging their citizens to buy gold. So it would be a bit of an anomaly to see the U.S., forbidding the ownership of gold and expropriating what gold the citizens might have, which at this point I don't think is very much.
So one of the things I often see, too, is, when I accumulate bullion and I just dollar cost average, and unless I see a real big drop, and then maybe I'll add more. But my objective, Nick, is to have as many ounces as I can, and the least amount that I have to pay for those ounces, meaning the least amount of premium and cost, that's the most important thing to me, because at the end of the day, it's just like any bull market. If you were investing in stocks, the more shares you owned at the end of a bull market, the wealthier you were. If you're talking about a bull market in gold and precious metals, then I would assume that, the more silver ounces I own, the more gold ounces I own, the better off and wealthier I'm going to be.
That's right, and I agree with that completely, but I would add one more factor to it, and it really depends on the degree of your wealth, and that is that your ownership of your insurance policy being gold and silver needs to be diversified geographically. And when I set up our Bullion Bars program, that's what I thought, that if one was to win $100 million in the lottery, what would you do? you'd put it into physical bullion and have it stored in, half a dozen different countries.
And the reason, once again, just in case, one of the things I could see them doing, and we already have this in existence right now in the United States, is, Nick, when I buy a stock and I own it long term, over a year, and I sell it, I pay a 15% capital gains rate.
Right.
If I own gold bullion and hold it over a year and I sell it, I pay 28%.
In Canada and most other countries, we don't have that differentiation. There's like one capital gain rate. There isn't different capital gain rates, and many countries have no capital gains at all.
Yeah, so not only do you not pay capital gains, but you pay a lower rate, or as you mentioned, one rate. So, well, listen, Nick, as we close, I know that you have not only the Millennium Bullion Fund, but you also deal in bullion and bullion storage in some places. And once again, I also want to bring up the fact that there's still that issue that we dealt with back in April, that, the gold's not there, the silver's not there, a big bullion bank's going to default. Last time I know that with your fund, you have your fund audited, and as far as I know, your bullion's still there.
Well, that's right. We checked that up, but we document it fully as well, because like every month we get additional reports from Scotia on the exact bullion holdings, and every bar is identified by refiner, serial number, exact weight, and exact purity, and that's what you need. Where the problems lie is people try to go to save money and don't clearly understand that they're, investing in bullion accounts, which are bank, IOUs, or their certificates, or their unallocated accounts, or in some cases they're financing it and there's no bullion there at all, and then anything happens and they're surprised. The issue is you first have to buy the bullion and get title transferred to you, and then you have to keep it in allocated storage with a credible custodian. And the people that are having problems haven't done that. And the problems will increase dramatically, and you will have massive defaults because there's been a lot of paper bullion and proxies and derivatives of bullion written, and people think they own bullion.
Yeah, you bring up something very important. A lot of people think that, when you're not paying any storage charge...
If you're not paying any storage charge, then you don't own the bullion. I can tell you that for a fact. That's one of the indices of proving that you own bullion, is to pay storage charges.
Well, I think you bring up some good points. So from your perspective, at least at this point, it's unlikely that we're going to see this. Of course, nobody can ever rule out it could become a possibility, but you don't see this right now as a possibility. And also, as you point out, when the government did make it illegal to own it, that when you turned it in, they paid you money for it. It wasn't like they went in your house and they took it away from you and you got nothing. That's
right. That's why I say for that to happen, the gold price would likely be $5,000 an ounce, and even if they did that as a worst-case scenario and you turned it in, getting $5,000 an ounce, having owned gold is better than not getting $5,000 an ounce, even though the currency is depreciating and you'd have to spend it on something fairly quickly, but that was the issue. All right. Well, listen, Nick, if our listeners would like to find out more about the BMG Group, how could they do so, please? Well, our website is just bmgbullion.com as one word, and we have a significant number of reports and e-books and so on that people can download for free, and are welcome to do so. All right. We've been speaking with Nick Barisheff. Nick, thanks for joining us on the program. Thanks, Jim. Good talking to you again.
You're listening to the Financial Sense News Hour at financialsense.com.
Continuing our discussion with investing in gold and gold confiscation, joining us from Spain is James Turk, founder of Gold Money. And James, on the day you and I are speaking, gold's down little over $22 an ounce, silver's down over $1. The cable channel people are been screaming, gold's in a bubble, gold's in a bubble. Last year, gold was up close to 30%, silver's up 80%. I mean, how many times in this decade have we been through this corrective process after a huge run-up? I mean, it's just the norm, and every time we get one of these, we got the guys on the cable channels telling us why it's in a bubble, and it's time to buy something else. Why don't we begin with that?
Yeah, no, you're absolutely right, Jim. You know, we've seen this countless times for the past 10 years, but there is something a little bit different this time around. We're only, maybe 6.5% below the recent record high. And as a consequence, the negativism, the negative sentiment has come in at a much higher level than it ever has before over the past 10 years. 6.5% dip from a record high is nothing in terms of the scheme of things. So it's quite surprising to see all of this negative sentiment build up so quickly. And, being a contrarian, I take this all as, as very, very bullish. When I did my forecast for 2011, my view was that we would see the low for the year in January. And, I even thought maybe we would see it in the first week, which was, obviously not the case because, here we are at the low for the year at the moment. But I do believe that, we're at or very close to the low for the year because all of the things that have been driving gold and silver too, for that matter, higher are still very much in place. So this is just a normal correction in what I think is at least 3 to 5 years left in the bull market in the precious metals.
How much of this is hot money flowing in and out? Because you know what the markets are like today, James. Everybody has a chart software program. You've got a lot of momentum traders. You got day traders. They don't care what they're buying. If gold's going up, like it did last year, or silver's going up, they're jumping on board the trade. It's amazing to see so many of even the newsletter writers who have gone almost overnight overly bearish. And, gold is touching close to its 200-day average, so there should be strong support here. Has it surprised you? Maybe not, because we've seen this so many times. Anytime it pulls back like this, it's almost like an immediate flip-flop. Oh, nope, now I'm bearish.
Yeah, I know. It's a good observation. And it's one of the reasons, Jim, and I've said this many times over the years as I've spoken on your show, you need to have a game plan in order to approach, any market, but particularly the precious metals market. And what I've been recommending is that every month or every quarter, whenever your budget allows it, regardless of the price, just go in and buy, the traditional, typical dollar cost averaging program. And what that does is it takes the emotion away from your program, from the accumulation of precious metals. I remember having this conversation back when gold couldn't get over $320, back in the early part of the decade. And it was under that level for, months on end. But, eventually it took it out. And, eventually we're going to take out 1,400 and 1,500, and we're going to go much, much higher. And if you take an approach with a disciplined, dollar cost averaging method, days like today, it really don't matter. When you dollar cost average, some days you're going to be buying at a slightly higher price, some months at a slightly lower price. But in the scheme of things, a couple of years from now when you're looking back, you're going to be happy.
It's funny because you've seen that recommended in bull markets. This was a very common recommendation. The mutual fund industry was great at this during the bull market, is just dollar cost average. And if at the end of the day, at the end of the bull market, the guy that wins is the guy that has the most shares, the same analogy applies to the gold or silver market. At the end of the bull market, the guy that wins is the guy that has the most gold ounces or silver ounces or platinum ounces. I mean, and I do just what you're talking about. Every single month on the 15th, I just dollar cost average. Well, you know what? The gold and silver I bought on the 15th is lower than what I could buy it today. Do I care? No.
Yeah, that's really good observation. And it sort of brings up another point that's related to this. To really make money in a bull market, you have to play for the length of the bull market. Buying and selling. The only person who gets rich when you do that are the brokers, and if you happen to be a trader or a professional speculator, you might make some money. But for most people, the accumulation program is the way that it works, and that's how you really can make some serious money in a bull market. You just keep buying, and you keep buying until we finally change, and we'll change when eventually we can see, valuations become overvalued, sentiment changes. We're in stage 2 of gold's bull market. Stage 1 was the first 10 years when we were under $1,000 an ounce. There was apathy, neglect, even though gold was generating double-digit rates of return on average over the 10 years. But when we went over $1,000 an ounce, we entered stage 2 and the sentiment changed. More people are starting to pay attention, more people are looking at it, more people are jumping on board. And inevitably, some people are going to be buying at a price that is higher than it was a week ago or than it is today. And if you don't have this game plan focusing on the reasons why you bought it in the first place, you might get shaken out, and that's one of the worst things that can happen when you're in a bull market.
As far as gold being in a bubble, I want to get to the sovereign problem here in just a moment. But Mark Faber made a comment in his December newsletter how if it was in a bubble, it's the most under-owned asset, because I would challenge anybody on the cable channels to look at a 13F of a mutual fund company and see where, you remember this, James, in the 90s, it was not unusual to look at a mutual fund holding and they'd have 60-70% of their stocks in technology. How many guys on the street really own gold? And if you take a look at even the mutual fund levels, you tend to see something like a Barrick, you see a Newmont, you see an Agnico, but, maybe it's 2% of the portfolio, 3% of the portfolio.
Yeah, it's probably a lot less. Sprott Asset Management in Canada put out a wonderful chart, I guess a couple months ago, and what it did, it looked at gold valuations at various peaks over the past century at key levels. And typically, the bull market in gold ends when it's approximately 20 to 25% of world's financial wealth. And at the moment, it's only 0.5% of the world's financial wealth. So, gold is under-owned. It's still relatively good value. And in my view, it's going to be going much, much higher. And the reason, of course, is that national currencies are being mismanaged. Purchasing power of national currencies is being debased by all of this money printing and bailing out of insolvent banks and insolvent governments around the world, which is eroding the value of national currencies.
Let's talk about the dollar for a moment. My analogy of the dollar, it's the best looking house in a bad neighborhood. But if you look at the budget deficit, we took a look at last year's Treasury numbers in their financial statements, and James, 80% of the government's budget is untouchable. It's entitlements, interest on the debt, and defense spending. And if you take a look at the U.S. this year, we still do not have a budget number. But, all indications are that the budget deficit is going to be somewhere between 1.2, 1.4 trillion. In addition to that, the U.S. has $2.7 trillion of short-term debt coming due. So if you add the current budget to the amount of debt that's coming due, that's $4 trillion. That's a lot of money. And if you take a look at the Fed's balance sheet, and several people have written about this on the web, the Fed's buying all this stuff. They're buying these 10-year notes. And come June, when the $600 billion of QE2 is done, where's the government going to get the money to fund the deficit and the debt that's coming due? That would be my first question. And number two, if the Fed was to exit its program and it was to start selling those 10-year bonds it's bought, and interest rates were rising as much as 0.5%, technically, the Fed could be insolvent. So what kind of exit strategy? I just don't believe it. Do you?
No, I don't. And the answer to your question, really quite simple. After QE2 ends, you're going to see QE3 and QE4 and QE5. And, ultimately you're going to see, in my view, the hyperinflation of the dollar. The point you raised about interest rates is also, important. One of the reasons that's left unsaid as to why the Federal Reserve is keeping interest rates as low as they are is because the U.S. government can't afford to pay high interest rates. And look at it this way. We've got $14 trillion debt now, direct debt at the federal level. If interest rates go up 1%, that's approximately $140 billion a year added to the federal budget deficit. And it's going to take something a lot more than 1% to really bring interest rates up to a normal level, given all of the inflationary pressures we see building up in commodity prices and other areas of the economy. So There is a bubble out there, Jim, and the bubble is called the U.S. dollar and U.S. government debt. And this bubble is going to pop. It's already, I think, popping when we started seeing interest rates rising a couple of months ago. And then the Fed announced QE, and we've had a little bit of a temporary respite while the Fed has been ongoing with its purchases. But it's clear that there's more selling of U.S. government paper than there is buying. And even that last auction where they bought, which was supposedly successfully bid at $14 billion, 10-year notes, half of it just got sold by the primary dealers back to the Federal Reserve. So the Federal Reserve is now the biggest holder of U.S. government debt. And, that's a sure sign that we're on the road to hyperinflation. They're turning all of that debt into U.S. dollar currency.
Let's talk about some of the implications of that. And there's been a lot written recently about gold confiscation. And I want to get your opinion. Is that a possibility? How would it occur? Who would comply? And then I want to talk about capital controls, because one of the first things that governments do when their currency comes under attack, and especially if it's being dumped and people want to exit the currency, as we're seeing the Chinese do, is they put in capital controls. So let's begin with capital controls and then go from there to the possibility of confiscation. We've seen gold go up. Could they someday, in order to stem a crisis in paper money, remonetize gold and confiscate it?
Yeah, it's entirely possible. It's already happened once with the 1933 confiscation. Who's to say it couldn't happen again? And, with regard to capital controls, we already have them. The fact that you have to do all of this reporting if you take $10,000 across the border, or if you're in Europe, 10,000 euros across the border. These are a form of capital controls. Most of the stuff with the Patriot Act is a form of capital controls. And outside of the United States, it's almost impossible now for a U.S. citizen to open a bank or brokerage account because of this qualified intermediary status that the U.S. government is trying to impose on the rest of the world. That is also a form of capital controls. And, if you look over the past several years, these controls are becoming more and more draconian. They're restricting Americans the ability to do what they want with their money. And whenever you do that, it is a form of capital control. And as the financial crisis, I think, gets worse, which I expected to do this year, that, you can expect more controls. And all we have to do is look at what's going on elsewhere in the world with other countries. Argentina, for example, confiscated pension plans in order to help its government deficit. Ireland, they didn't call it a confiscation, but in order to bail out the banks there, they dipped into pension plans and forced those pension plans to buy debt from insolvent banks. So, that's a form of capital controls and confiscation as well. We're really on in my mind, a terrible path. We've moved away from the basic principles of property rights, rule of law. Governments are there to protect the rule of law, and they're doing everything but. And ultimately, if you destroy the money, you destroy the society. And that, unfortunately, seems the way we're going. I wish I could be a little bit more optimistic about the near term, but I really think we're headed for something quite serious and quite catastrophic here in 2011, probably in the first half of the year.
It's amazing because there was a story out today on a city in California that filed for bankruptcy last year. And the municipal bondholders, they're going to protect the government employees, they're going to protect their pensions, but the bondholders are lucky if they're going to get a nickel on the dollar. And it just absolutely amazes me at the number of things I read that are recommending muni bonds. And I'm almost thinking, and the reason they're recommending muni bonds is because of the yield on munis compared to, let's say, what you could get in treasuries, which are artificially suppressed. So they're saying, boy, this just represents a great bargain. And it's like, James, nobody knows how to read a balance sheet of a state. Our own state here, we're not going to do anything other than extend the existing taxes that are already in place. The governor is going to take the general fund expenditures and he's pushing them off to the local counties and states as of like that debt goes away or these expenditures go away. But, I see, just as in your neck of the woods where you have individual countries now that are under pressure, where you're staying at right now, some are suggesting maybe Spain's next. Well, if Spain's next, what about California, Illinois, New Jersey, and some of the other states If the federal funds that were given to the states that kind of forestalled the crisis are running out, what do the states do next? They can't print money.
Yeah, you're absolutely right. And you can see the different alternatives that they have. Illinois decided to raise income taxes, and New Jersey went the other way. They're trying to cut expenditures. But, neither of these are really going to solve the underlying problem, that what all of these debts are doing is just consuming capital. This is not money that's being used to build roads or do anything constructive. It's maintaining consumption and current expenditures. And that's ultimately eroding the capital base of the country. And if you don't have a capital base, productivity and everything else, declines. And what the federal government is doing is it's just trying to tap more and more capital, but it's reached a stage now where less people are willing to lend to the U.S. government than what the U.S. government needs to borrow. And that's why the Federal Reserve is stepping in with this bond buying program, and that's how a currency ultimately turns into hyperinflation.
Now, there are some, James, that would argue that because we're a reserve currency, we can't experience hyperinflation the way that, let's say, Russia, Germany, Argentina, Turkey, and other countries have experienced. What would be your arguments against that?
I think that's more hope rather than, logic. If you look at the causes of hyperinflation, regardless whether it's within a country that isn't the reserve currency or is the reserve currency, the causes would be the same. We've never actually been in a situation where the reserve currency of the world is hyperinflated, because up until the last 40 years, the reserve currencies of the world have always been gold or paper currency backed by gold. But I think that's really, misguided thinking to say just because it's the world's reserve currency that it can't hyperinflate. The currency now is just based on nothing but government promises and the hot air and rhetoric of politicians. It's not based on anything of substance. And I think more importantly, though, is you just have to crunch the numbers and look at the debt load relative to cash flow. The numbers are truly, truly staggering. And it's no wonder that the Chinese have stopped buying U.S. government paper, and other countries have, been diversifying out of the dollar. I think things are stacked up against the dollar, it's becoming, in my mind, increasingly clear. And in this kind of environment, you don't want municipal bonds, you don't want government bonds. You only want corporate bonds if they're convertible into some kind of an equity of the corporation. And you really want tangible assets that make sense. And in terms of tangible assets that are liquid, gold and silver are at the top of the list.
Also, when you look at this situation that the U.S. government finds itself, I'm trying to think of the quote, but you've got 40% of the people of the country right now pay no income taxes. Now, they may pay Social Security taxes, but that's different than income taxes. You've got over almost half of the country, either 25% working for the government sector, and I forget what the percentage is, but it equals almost 50% that are on some form of entitlement. If you just look at the logic of that, government has gone from 19% of GDP, now it's 26% of GDP. So that means the private sector is shrinking. You have fewer and fewer Americans that are paying taxes, more and more Americans that are on some form of entitlement, whether it's unemployment benefits, food stamps, Social Security, or something. James, that's unsustainable. In other words, people have always thought of this country as a special country. But how could a country operate when the government is now borrowing, 42 cents out of every dollar it spends?
Yeah, it can't continue to operate. The United States has turned into Europe. It's just a big version of Greece and Ireland and, all of the other indebted, sovereign countries. But the difference, of course, is that, the U.S. has this position where the dollar has been accepted. But, that could change overnight, Jim. Just like confidence can change overnight in a country like Argentina. And, in 6 months you go from confidence in the currency to total hyperinflation and destruction of the currency. When you have a currency backed by nothing, confidence can change very, very quickly.
Well, I couldn't agree more. And I, like you, am not as optimistic. I think in the short run, as we start this year, there are a few things that are going well temporarily in the economy. but my gut feeling tells me is as we get closer to May and June, the real question is going to be, can the U.S. economy stand on its own without some form of either, money printing, government stimulus? And I just don't see that happening. Do you?
No, I don't. And you could take the same question related to the various states. What's going to happen in these states that are having debt problems that are just as bad as some of the countries over here in Europe? That's why I'm really quite concerned about the outlook here for this year. And I really do think that these serial bailouts that we've seen are going to come to an end. And I'm really expecting something unusual and cataclysmic to happen here, probably within the next 6 months.
When I was looking at the forecast for 2011 and I talked to various experts, and one of the wild cards I see is oil prices. I don't think the economy is strong enough to withstand triple-digit oil prices because everything in our economy runs on oil. Several of the other ones that were thrown out there were a crisis in Europe. We get Euro crisis 3.0, a crisis in China, or a crisis in, let's say, the States. And what are the odds, James, that we could keep oil prices contained, Europe works itself out, China has a soft landing, continues to grow without a hiccup, and the States somehow come out with a solution to get out of their debt problems? If I was a betting guy, that's not a bet that I would bet on happening.
No, that's, the odds of this, continuing for much longer are probably less than 10%. All they're doing is just buying time. If it doesn't hit in the first half of this year or the second half of this year, it's going to hit soon enough because they're not coming up with solutions to the problems, Jim. They're just basically papering over things. And here in Europe, they're even trying to disguise things now by having the debt auctions done through syndications rather than through, public offerings, where the debt is arranged by the banks and the banks buy the debt and then ultimately sell it to the ECB rather than trying to put it out into some kind of a public open forum. So the near term here, I really am quite pessimistic, and I think this is going to be just a lot of upheaval this year. And the best way to get through it is to own physical gold or physical silver, and if you're so inclined to take the investment risk, the stocks of the mining companies as well.
As we close, James, speaking of gold and silver, why don't you tell our listeners about Gold Money, what you do, and how they can find out more about it?
Yeah, I'm the founder and chairman of Gold Money. We're at goldmoney.com. We're a very convenient, economical, and most importantly, safe way to buy physical gold and silver and platinum. And we just added palladium as well this month. Buy it online and have it stored for you outside of the U.S. in vaults in London, Zurich, or Hong Kong, which is actually relevant, Jim, to the point that we were discussing about confiscation. When gold was confiscated in 1933, gold outside the United States was not confiscated, so Americans could own gold legally outside the U.S. And, of course, silver was never confiscated, so if you're worried about a gold confiscation, you can always buy silver. But anyway, we're presently storing about $1.5 billion worth of precious metals for our customers.
All right. And the website again?
Goldmoney.com.
All right. We've been speaking with its founder, James Turk. James, thanks for joining us on the program. I want to wish you a happy new year, and please come back and talk to us again.
Thanks, Jim. Will do. It's always a pleasure to speak with you.
Continuing with our discussion this week on gold confiscation and gold investing, joining us on the program is Kathy Dervis of KPM Precious Metals. And Kathy, I sent you a piece on gold confiscation, and I'd like to begin our conversation with that because you can see on the statutes, we've done it before, and you hear these thoughts come out. The regulation with the healthcare bill that we're going to have to start reporting, unless they repeal it, anything over $600. So I'd like to get your take because you're in the precious metals business. What's your take on that? Is it a possibility or is it a remote possibility?
Well, Jim, first, it's a pleasure to be back here with you. Thank you. And, the issue of confiscation comes up from time to time because it's normal for anyone who owns gold to think about the threats to it, right? We do that with valuable assets. But at this point in time, I think that there are far greater threats to our wealth than confiscation, simply because while there are a few similarities between now and the 30s, namely how we got into this financial mess, that being the Fed's misallocation of capital, there are quite a few differences. For instance, back in the 30s, everyone owned gold. It was legal tender and daily use. You could exchange your paper money for gold at any time. And in fact, after the stock market crash of 1929, so many people were doing that, exchanging their paper dollars for gold and putting their gold in the safety deposit boxes, probably because their confidence in the financial system had been shattered. And then later on, when it was really destroyed, that meaning the confidence in the financial system, there was a run on the dollars in the bank, and of course a lot of banks failed. Today, I would say that probably less than 1 in 1,000 people own gold. I'd actually be surprised if it was that many. Yes, a lot of banks have closed. I think we had 157 of them last year. But that has nothing to do with gold. It's probably more insolvency issues than illiquidity issues. The 2008 and the printing press have helped those out quite a bit. And, of course, we don't need to confiscate gold in order to revalue it up like they did in the 30s from $20.67 to $35 in order to expand the money supply. We're doing that at will now. I mean, we had, $1.5 trillion last year when the Fed monetized, $1.3 trillion now this year along with QE2. So, I don't see how confiscation would serve the same purpose now as it did back then. And, of course, run on the dollar can happen in the foreign exchange market any time. I'm not saying that it would, but it could. And perversely, this time around, it might come from outside of the country versus inside with U.S. citizens. So I don't see any of that happening. It would be a logistical nightmare. I mean, records exist for maybe 1/1000th of what people hold physically. It's very widely dispersed. Lots of it's probably been shipped out of the U.S. just like it was back then. So, I know the issue continues to come up because there are people who want to believe that their pre-1933 coins that were not a part of the confiscation in 33 just because they were deemed as collector's coins. They believe that if there is a future confiscation that they would protect them once again. And, I tend to think that's a false sense of security. On December 31st, 1974, President Ford issued Executive Order 11825, which repealed FDR's Order 6102 prohibiting hoarding. So, all I'm saying there is if you rely on an old laws, I really believe, they'll change and make the laws to fit the time we're in. And again, if there is an off chance that they would confiscate, I think there'd be signposts along the way. We'd see the government taking some unusual measures. A lot of things would have to happen before then. I think they'd only try it after they did try a lot of other things. So, and now I think about if they even mention confiscating gold, the message that would be sending is that the economic conditions we're experiencing now are much worse than they're reporting. That's the message it would send. That would probably destroy any shred of confidence people have left in the government and the Fed. So, it might have an adverse effect. I just don't know at this point in time that it's something that we should be concerned about. I really think there are other higher probability risks to our wealth now. And I continue to believe that owning as many ounces as you can for your paper dollars will likely help protect you from a wider range of threats to your wealth.
And is it more likely that we would see capital controls first, and then I guess maybe a second question is, I'm thinking I go with the Willie Sutton theory on this, and that is if they did say they were going to confiscate it, why go door to door for, Joe Sixpack and Larry Lawnmower's few gold eagles when you can go after the ETFs, which are much larger? And let's face it, most people trade the ETFs. It's just a paper trade for a lot of these guys. And when I say confiscation, when Roosevelt took the gold from people, he paid them for it. So if the guys that are in GLD and SLV, or let's say GLD, get payment in dollars, it's not that they didn't get something for it. But it seems to me if I really wanted to confiscate gold, I'd go where the biggest stash was.
Absolutely, and it would be perfectly legal. Unless you are in a certain subset, the way I understand it, it's like part of the LBMA, that you could not ask for gold in lieu of your shares if you're in the GLD or the SLV. So confiscating it would be perfectly legal. They would give you whatever it was trading for on the day that they decided to delist those particular securities, and all the gold would be sitting in vaults that they would know exactly where they are, probably in HSBC in New York. And I think it'd be a lot easier, like you said. I mean, why come after Mrs. Jones with 10 ounces? I mean, it would be just a logistical nightmare. I'm not saying they wouldn't do it, but I think, like you said, there are signposts along the way. I mean, the other thing they could do would be to start asking all of us as dealers for records of those who have bought gold. I mean, right now, it's only records who sell a certain amount of gold, not those that buy. So you're right. I mean, why would they come after us at this point in time when they have bigger pools sitting right there, all consolidated in one place? It just makes sense.
Something that strikes me about this market, Kathy, it was only a couple months ago that investors were praying for the opportunity to buy precious metals at a lower price, especially since silver and gold went ballistic in the last part of the year. Now that gold is consolidating or maybe even correcting, it seems that both institutional investors and the small guy are in no rush to purchase the precious metals. As a gold dealer, what can you tell us about the psychology of, let's say, today's gold and silver buyer that you're seeing?
Jim, doesn't this feel like exactly like last year?
Yeah, I know. Kathy, I know with our firm, in the month of November and December when gold was going up, the phones were ringing off the hook. But when they should have been ringing off the hook was during the summer when you could have bought it for a lot cheaper. It's just amazing how this market works. So that's what we've seen. What have you seen?
Exactly the same. It's human nature. We all fear how far down it can go when, if we're not in yet, we should fear how far up it could go without us, right? But it's just human nature. Right now, we're the classic selling at the beginning of the year, just like last year. My initial reaction is that a lot of people are taking profits on an asset that really worked last year. Gold was up 29.8%. It's silver up 83%. So, it would be taking some profits and deferring your tax liability into one more year. So that doesn't surprise me either. But most of what we're seeing, especially from our bigger buyers, and actually across the board, is that gold is likely in a trading range. We've seen a retracement. I have no idea if today is sort of the bottom of the retracement, but it's a retracement and a consolidation somewhere from, say, 1330 or maybe even 1300 to 1430. That's about a 7% or so decline from the high. That's not a big deal. It feels like a big deal when it's your money and you see the prices volatile on the downside, but most people right now are just trying to assess the bottom of the trading range, and that's the way we're looking at it, as a trading range and not a trend change. I really see nothing here that tells me that, it's over for gold, nothing at all. In fact, I don't see any froth in the market. The percent of the world's financial wealth in gold right now is minuscule compared to equities, fixed income, bank deposits. It's definitely not over-owned. So at this point, I think we're just in this massive trading range, and it looks to me that the macro forces are in place for gold to go up, long term. It doesn't go up on a daily basis, and of course people have a hard time valuing it. Can't do a classic discounted cash flow model, right, to tell you what the price should be, but people who own it understand the fundamental picture, and so for them, it becomes a matter of price, meaning try to find a price within this range that they can live with and the number of ounces they want. So that's about it.
One thing that we have seen over the last 10 years, Kathy, is gold has gone up 10 years in a row. Last year marking the 10th year. This year, we're starting out with a correction. If we were having this conversation, let's say it was December 31st, 2011, and for whatever reason, the price of gold ended up closing the year with negative returns for, let's say, the first time in a decade, because what has struck me about this bull market in this decade is we have not had one negative year. You contrast that to the bull market in the 70s, where between 73 and 74, we saw gold go from 200 down to 100, a 50% correction. We have not had a negative year in gold. So I guess my question would be, is if we were to have a negative year in gold, negative returns, in your opinion, would that surprise you? And what kind of economic or political conditions, I guess, would you expect to accompany a gold decline?
Doesn't it surprise you, Jim, 10 years of positive returns? And it's still so incredibly under-owned and not really widely understood. But I think what you're talking about now is that there are always flashes of optimism in negative economic environments, and that puts downward pressure on gold. Of course, we all want to believe that the worst is behind us. That's human nature. I don't know anybody who wants to think that the future is not so bright, right? Even when reality tells us differently. So right now, I think that people just want to believe that the Fed can bail us out once again, when you and I both know that they're very, very trapped. But yet they're still propping up some assets like real estate with printed money while our foreign creditors rebel. So, I guess the real question is how long can the Fed maintain credibility? I don't know. For a while. How long can this optimism last? A while. But it can't last forever. Reality will catch up. The reality that the domestic picture is deteriorating. We see high unemployment. Some states have imposed higher taxes. We saw that with Illinois last week when they went from a 3 to 5% tax. We're seeing higher prices in food, energy, medical costs, education, setbacks already in the bond market, and those rising interest rates could cause another leg down in the real estate market. So for those looking towards the equity market as the don't worry, be happy crowd, I suppose they could look at that as a continuing barometer of the overall health of the economy. I happen to feel like it's not, but we all know that the equity market can roll over at any time. So, optimism will fade when reality really does set in, the reality of higher prices and what we use daily and lower income, and eventually psychology about the dollar will change. That people will eventually perceive paper money as becoming less volatile, but gold could be down for a while. I just really believe that the macro forces are lined up to support higher gold prices long term. And, remember last January, we started out like this. Gold went from roughly 1162 or so, right, something like that, to 1040, which is about a 10% decline. I remember sitting in the seat thinking it was brutal, and we ended up the year 29.8%. Silver did much, much better at up 83. This year, we've gone from, roughly 1432 down to 1340-ish or so today, and 5 3/4, 6% decline. So, could we print a down year? Sure, absolutely. We could print a down year. It would surprise me, though. It wouldn't shock me, but it would surprise me just given what's going on fundamentally out there, because nothing's changed. We're still in a long-term bull market for gold.
You know what really strikes me about this, Kathy, is I'm almost calling this deja vu because, as you just mentioned, last year at this time we were going through a 10% correction in gold. The leading economic indicators were roaring and everybody was, look at this recovery. We had a remarkable stock market in 2009 and the economy is growing strong. GDP growth in the fourth quarter of Q9 was 5%. And then at the end of March, the leading economic indicators began to roll over. And between April and June, the stock market lost 15 or 16% of its value. And all of a sudden in August, the Fed went from talking about an exit strategy to, oh no, QE2 is coming. And I almost see a replay of that right now. The LEIs have been going up. There's a feeling in this country that, I'm sure fourth quarter GDP is going to be stronger. It's going to be over 3% or more. And what may surprise on the upside of the first part of the year is the economy is stronger, profits are stronger. And so everybody says, maybe I don't need that safety trade anymore, gold and silver. But my gut feeling tells me that as these commodity prices head up, that as oil prices get into the triple-digit level, at some point we're going to start to get in trouble. And I would be surprised by the end of the year if, or sometime after QE2 ends, my friend Ben, and by the way, he was my best friend last year.
Mine too.
Yeah, Ben starts talking about QE3, especially with a presidential election in 2012. But doesn't it strike you how eerily similar it is to what happened last year?
Yeah, and it's very, very close. It feels like that, at least at the start. I mean, when you throw Europe in the mix, you remember what happened with the Greeks beginning, I think that was, like you said, February, March, April of last year. We have the same thing going on now with Portugal, Spain. I don't know if they'll get to Italy. So, well, it seems at this point in the year that it could be a replay. I think what we have is a replay, but this stretched even more. We have all of QE1 that's come into the market. Now, of course, we have QE2 that's on the table, and it'll be fascinating to see if Bernanke decides to at least temporarily suspend the QE2 or let it just roll off in June like they say they're going to do, or maybe perhaps this time they've learned and we'll go right into QE3 and QE4, which of course would change the end of the year. And so, I don't know. I don't see a whole lot of difference there, except that we're becoming more and more stretched, and the effects of printing and monetizing are showing up more. And that's in higher prices in food and like you said, all commodities across the board, energy. We see it in place medical, educational. You see it. I just got a letter from my cable company. Rates are going up there. So I just think we're a lot more stretched this year than we were, and the reality that inflation is here through, of course, the monetizing of the debt will begin to hit us a lot earlier this year than last year. So the psychology surrounding that may actually begin to change this year where, I don't think it changed much last year, even though people knew that their cereal boxes were less full, or maybe the candy bars were a little smaller, or maybe their paper towels were, shorter. I don't know. This year, I think they're going to be able to be seeing that more and more and more, and that's going to feed into inflation expectations this year much more so than it did last year. So it's going to be really fascinating, isn't it?
Yeah. Final question, Kathy, as we close. What do you see as the best bargains out there in the metals market? You and I were talking earlier in the week that what is commonly referred to as junk silver, which are the old 63, 64 silver
right?
coin. Uh-huh. Yeah, 65 coins represent a real bargain. Outside of that, where do you see are the best values?
Well, when it comes to premiums over spot, of course, we always believe you just buy the least expensive coin or bar, whatever you prefer, in gold, silver, platinum, palladium. So, I can tell you right now, on the gold side, it's readily available. I would just buy the least expensive. what we have happening in January, as we do every year, is just the classic calendar effect, where at the end of the year, the sovereign mints slow down their production in order to retool and put the new date on the coins. Of course, bars don't have dates, so it really affects the coins. But anyway, so you see less supply, and of course, the demand has not waned at all. In fact, it's remained very, very steady, especially for silver. So in the fall, U.S. Mint, the Royal Canadian Mint, increased their prices on silver eagles and silver maple leafs by 50%, because, frankly, the price of silver had gone up so fast that their cost for securing planches had increased, and they were just trying to maintain their margins over spot. So, that really was a price issue. Right now, we just have a calendar issue where it's more of a supply and demand issue. But that, we're getting to 2011s, and I think that particular anomaly will work itself out within the next 30 days. And, by the way, Royal Canadian Mint always gets ahead of the crowd and sends theirs early. We get the maple leafs for the next year in October or November, so we're well supplied there. I think that on the silver side, if you want coins, the Canadian maple leafs are a great deal right now. The 100-ounce premium bars, which are Johnson Matthey, Engelhard, or Royal Canadian Mint, those are always, being a bar, of course, a lot less expensive to buy over spot. I think that's a great place to be. In the gold, again, buy the cheapest. That right now, mostly because of the calendar effect, but always the maple leafs are a tiny bit less expensive than the eagles, as they are now. And, of course, like you said, the 90% are at historical lows in price, and I just don't see how they can go much lower, because you probably would just take them to a refinery, right, if they did. The silver rounds are still delayed, because those are the pure silver that are not minted by the sovereigns, that there's no existing supply. Everything that's being sold is fresh production, and that takes about 2 weeks. So we're down from maybe a 4-week delay to a 2-week delay. So that's beginning to work itself out. So, I think that I would, again, just buy as many ounces as you can for your paper dollars. Get the cheapest. The most important thing really is for you to be comfortable with the price, because the premiums become meaningless if the price moves against you, 3, 4, 5%. So when you're comfortable, you buy the least expensive, and of course we can help all of our clients determine what that is at the time they buy. And I just think that's a really good strategy. It's a healthy strategy, and it's one that's going to benefit a lot of people in the long term.
All right. Well, listen, Kathy, as we close, if our listeners would like to find out more about the services that you offer, please give out your website, if you would, and your phone number.
Thanks, Jim. Our website is kdpm.com. You can find us through our toll-free number, which is 877-718-8777. We're happy to help you. And again, it's been a pleasure to be with you. Thank you so much.
All right. We've been speaking with Kathy Durbis. She heads up KD Precious Metals. And Kathy, thanks for joining us on the program. Come back and talk to us again.
Oh, I'd love that, Jim. Thank you. Appreciate it.
I think, Jim, we have transitioned rather nicely from a year of transition, and you can see a whole new scenario shaping up this year, and we're just in the first month of the year. So what are we covering for the next couple of months and on to the rest of the year?
A couple things. Next week, Mary Buffett, the former daughter-in-law of Warren Buffett, will be on the program with her associate David Clark. She's written a new book called Warren Buffett and the Art of Stock Arbitrage. Now, what you're going to find interesting in this interview is Warren Buffett is known for his value-type long-term investments. What is little known about Warren Buffett, because he very seldom talks about, is his arbitrage investments. You back out his arbitrage returns from Berkshire Hathaway, it reduces his returns by a full 10 percentage points. So they've written a new book called Warren Buffett and the Art of Stock Arbitrage. That'll be January 26th. On February 2nd, the Little Book of Economics, How the Economy Works in the Real World. Greg Ip will be my guest. He's a journalist with The Economist, formerly with the Wall Street Journal. well. And if you've ever had trouble understanding economics, you will learn more from this book in terms of how the economy works than anything you ever took in college in an economics course. So Greg will be on the program. Fabulous little book. It's not very complicated, and what he does extremely well is take a complicated subject, makes it really easy to understand, and then relates it into tools that you can use as an individual or an investor. And then on February 9th, Klaus Vogt will be here. He is the managing partner of Aquitas Capital Partners. He's written a new book called The Global Debt Trap, How to Escape the Danger and Build a Fortune. On February 23rd, the Great Super Cycle, profiting from the coming inflation tidal wave and dollar devaluation. David Skorica will be my guest, and we have a lot of great stuff coming up in the months ahead, as well as some special programs that we're going to be doing here on the Financial Sense News Hour, changing things up a little bit in the year ahead. As usual, it's hard to believe that we're almost done with the month of January. So on behalf of John Leffler and myself, we would like to thank you for joining us here on the Financial Sense News Hour. Until we talk again, we hope you have a pleasant weekend.
You've been listening to the Financial Sense News Hour with Jim Poplava. The Financial Sense News Hour is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell securities. Responses to listener inquiries are based on the opinions of Jim Poplava and do not take into account listeners' suitability, objectives, or risk tolerances. You should always consult a qualified financial advisor before making investment decisions. Financial Sense will not be liable to anyone for financial losses resulting from companies profiled or information provided on this program. The Financial Sense News Hour was produced by Steel on Steel Productions. Join us again throughout the week for more in-depth news and financial analysis at financialsense.com.